October, known for historic market crashes and the infamous October effect, is viewed with trepidation in the world of finance. With a tumultuous past, the month evokes fears of potential market downturns, unsettling investors. The culmination of various economic factors and historical precedents raises concerns about the potentially ominous impact of October on Wall Street. Wall Street is a famous street in the financial district of Lower Manhattan in New York City, and it holds significant importance in the world of finance. It is often used as a metonym to refer to the financial markets and the financial industry of the United States. Wall Street is known for being the historical headquarters of some of the largest U.S. brokerages and investment banks. The name Wall Street has historical significance. It dates back to the 17th century when the Dutch first settled in New York, which was then called New Amsterdam. In 1653, the Dutch built a wall to protect themselves from the British and Native American attacks. This defensive wall was known as de Walstraat in Dutch, which translates to Wall Street in English. This wall ran across the northern boundary of the settlement. Over time, the wall was dismantled, but the name Wall Street remained, even after the British took control of the area and renamed it New York. During the late 18th century, Wall Street became the location of the first official bond and securities trading in the United States. In 1792, the signing of the Buttonwood Agreement by 24 stockbrokers gave birth to what eventually became the New York Stock Exchange, or NYSE. This historical event solidified Wall Street's role as a hub for financial trading and established it as a symbol of American capitalism and financial power. Today, Wall Street represents the heart of the American financial system, housing major stock exchanges, investment banks, and financial institutions. It serves as the epicenter of global finance, with significant influence over international markets and economies. As a result, movements and trends on Wall Street often have widespread effects on financial markets worldwide, making it a key focal point for investors, economists, and policymakers globally. Talking about October market history, the historical precedents of significant market crashes in October have instilled a sense of caution among investors during this time of the year. Events such as Black Tuesday in 1929 and Black Monday in 1987, both occurring in October, have contributed to the perception of heightened market risks during this particular month. Investors remain vigilant and mindful of historical trends, acknowledging the potential impact of historical market crashes on current market sentiment and behavior. There's a growing fear among investors that the stock market is on the brink of a significant decline. Some financial analysts are even suggesting that this potential drop could be as severe as 30% or even 50%. The prevailing unease stems from a combination of factors, including recent market instability and uncertainty surrounding economic policies and global events. Investors are bracing themselves for the possibility of a substantial market correction and its potential impact on their portfolios and investments. Recent market conditions have been challenging, leading to increased uncertainty and volatility. The decision of the Federal Reserve to maintain higher interest rates for an extended period has amplified concerns among investors. The prospect of prolonged high interest rates could dampen economic growth and impact various sectors, including housing, consumer spending, and business investments. Investors are closely monitoring these developments, anticipating their potential repercussions on the broader financial landscape. With the continuous rise in mortgage rates, prospective homeowners are facing mounting challenges in affording new properties. This trend has sparked worries about a potential slowdown in the real estate market, impacting not only home buyers but also construction and related industries. The strain on housing affordability is anticipated to have a ripple effect on consumer spending and saving habits, further influencing overall economic stability and growth prospects. The current climate of political uncertainty and the looming possibility of a government shutdown have added a layer of concern for investors. The potential disruptions in government operations and policymaking processes could have far-reaching consequences on various sectors, including financial markets, as market participants grapple with the uncertainties arising from political gridlock and its potential impact on the economy. As the fiscal year-end approaches, for many mutual funds, investors are anticipating potential adjustments in investment strategies and asset allocations. The practice of window dressing, where fund managers sell underperforming assets and purchase better-performing alternatives, is expected to influence market sentiment and potentially amplify fluctuations in the market. Investors are closely monitoring these portfolio adjustments, which could impact market dynamics as the fiscal year draws to a close. Financial experts and analysts have been issuing cautionary statements regarding the possibility of an impending market downturn. citing both historical events and present economic indicators. These warnings emphasize the need for investors to exercise prudence and vigilance in their investment decisions. Recommendations to diversify portfolios, hedge risks, and adopt defensive strategies reflect the prevailing sentiment of uncertainty and apprehension within the financial community. Discussions surrounding the current state of the economy and the implications of rising bond yields have gained significant attention. The impact of escalating bond yields on borrowing costs, business investments, and overall market stability has become a focal point of analysis. Heightened discussions on inflation, employment, and economic growth prospects have contributed to a nuanced understanding of the intricate relationship between economic conditions and bond market dynamics, with implications for various sectors of the economy. In anticipation of potential market turbulence, some financial institutions have advocated for proactive measures, including revising market predictions and maintaining cash reserves. The emphasis on readiness for market fluctuations reflects a proactive approach to risk management and strategic planning. The evaluation of investment strategies and the exploration of defensive positions underscore the importance of preparedness and adaptability in navigating the evolving market landscape. October, which is known for spooky tales and Halloween, actually holds a different kind of fright for investors. Some people say that it's a scary time for the stock market too. They call it the October effect. This is the belief that the stock market tends to fall during this month. But do you really think all of this is true? Let's take a look at some spooky moments from the past. In the olden days, 1907 saw the Panic of 1907, a big fright for the economy. Then came Black Tuesday in 1929, followed by Black Monday in 1987. These events made October seem like a haunted month for investors. But the truth might surprise you. The surprising thing is that the real trouble often started earlier in the year. It's like when a thunderstorm is predicted, but it doesn't arrive until later. Similarly, these crashes had their roots in issues that began earlier. For example, the Panic of 1907 had whispers of worry as early as March, while the storm of the 1929 crash was brewing in February. It's like the scary part happened in another month, but the effects only showed up in October. But why does October get such a bad reputation if the troubles started earlier? Well, the spooky name Black Monday or Black Tuesday adds to the scariness. These names make people remember October as a frightening time, even if the actual troubles began elsewhere. Interestingly, if we talk about September, September seems to have a more troubling history than October. If we look back at the records, September was often the one causing more worry for investors. It's like September is the mischievous troublemaker, while October takes the blame. But is the October effect really a thing? Well, there's a lot of debate about it. Some people say it's just a story that people believe because of some historical events. It's like a scary legend that everyone knows, but it might not be true. If we look at the numbers, they tell a different story. Over the years, October has been more of a treat than a trick for the stock market. It's like a friendly ghost instead of a scary one. On average, the stock market has done quite well in October, even though people expect the worst. The world of finance can be confusing. Sometimes people believe things that might not be true. It's like believing in ghosts even when there's no real proof. The important thing is to look at the facts and not just the scary stories. In the world of finance, October has garnered a reputation as a feared month due to historic market crashes. However, a closer look reveals that the actual troubles often began earlier, with September being more worrisome historically. The concept of the October effect remains a debated topic, with some attributing its existence to mere superstition rather than concrete evidence. Despite the haunting tales, the numbers suggest that October has been more of a favorable period for the stock market than commonly believed. It's crucial to rely on facts rather than myths in navigating the complexities of the financial world. If you found this information helpful, please remember to like, share, and subscribe to stay updated with more valuable insights. Thank you.